Right now, there is an army of uneducated amateur traders hitting the jackpot, and they are utterly destroying the returns of seasoned Wall Street veterans. Take Dave. Dave has been trading for exactly 2 years. In financial terms, he's a toddler who just discovered how to strike a match. But his portfolio is up 13% year to date, thanks entirely to a massive lucky bet on a completely random crypto meme coin. Dave spends his weekends watching The Wolf of Wall Street and pitching emerging biotech penny stocks to girls at the bar. Compare that to the institutional analysts down on Wall Street who spend 80 hours a week building complex discount models to determine a fair valuation. So how is the toddler beating the analysts? We have to figure out if Dave is an undiscovered quantitative genius or if he's simply sitting at a table where the math forces him to win. Flush with meme coin cash and overflowing with unearned confidence, Dave does what any rational novice would do. He calls up his broker, grossly inflates his net worth, and gets approved for max leverage. Traditional value investors like Warren Buffett look for stable, blue-chip companies with solid cash flows. Dave's strategy is a bit different. He ignores valuation logic entirely, choosing to buy companies trading at 650 times their earnings and pouring money into absurd internet trends. His risk management strategy essentially relies on prayer. Meanwhile, out in the real world, his wife is actively wondering why $13,000 is suddenly missing from their joint savings account. This is the Dunning-Kruger Effect playing out in real time. Novice investors ride a wave of circumstantial luck, misinterpret that luck as extreme intellectual skill, and trap themselves in a cycle of worsening financial decisions. To actually understand Dave's portfolio, we have to ignore Dave completely and look at the broader US stock market over the last 2 decades. This chart shows the overall performance of the market since 2009. We have been sitting inside the greatest, most relentless bull market in recorded history, a 17-year stretch that has generated aggregate returns of over 715%. In an environment with this much aggressive, positive momentum, throwing a dart at a board of stock tickers would likely yield a profit. When the baseline refuses to go down, the absolute worst, most irrational, hyper-aggressive investment approaches actually begin to thrive. They even start to outperform sensible strategies. Dave isn't spotting hidden value or picking winning assets. He is simply existing inside a massive macroeconomic elevator that is rocketing upward, mistaking the machinery of the building for his own ability to fly. Beta measures a stock's volatility against the market. If beta is 1.33, it's 33% more volatile. When the market rises 2%, the high beta stock shoots up 2.66%. But if the market drops 2%, the stock plummets equally. Retail investors naturally gravitate towards the adrenaline rush of out-of-the-money tech calls and wild meme coins. By default, they are building portfolios stuffed entirely with high beta assets. Because volatile assets multiply the market's gains, Dave looks at his account and believes he has the trading instincts of George Soros. He doesn't. A high beta portfolio guarantees that a trader will outpace the average during a massive bull run. The math transforms reckless gamblers into temporary prodigies, entirely by accident. But historically, every bender eventually comes to an end. Fast forward just a few months, and the macroeconomic elevator suddenly stops. The Federal Reserve steps to the podium and decides it is finally time to hike interest rates. The second the broader market reverses, the double-edged sword of beta activates. The mathematical multiplier that built those amateur portfolios immediately begins dragging them down, wiping out value exponentially faster than the rest of the economy. Dave's highly leveraged options and meme coins collapse. His portfolio quickly drops by 67%, and his wife's new favorite hobby becomes Googling how to divorce a man who calls himself a market wizard. Mathematical gravity is absolute. Buying volatile assets on margin without understanding the underlying mechanics of beta is fatal the moment the overall market trend shifts. Taking a massive loss on the chin requires humility, which Dave's ego will not allow. His psychological defense mechanisms kick in, preventing him from admitting that his initial success was just dumb luck. Instead of recognizing his own lack of risk management, he points the finger outward. He blames institutional market makers for manipulating the charts, and he specifically blames Jerome Powell for wrecking the economy. If that doesn't soothe the sting of a blown-up account, he will pivot to blaming political figures like Donald Trump for the market reversal, doing anything to avoid taking actual accountability. A rising macroeconomic tide lifts even the dumbest boats. Everyone looks like a financial genius when the entire system is designed to go up. True skill is only revealed when the tide inevitably rolls back out.